Hello traders, this is Chris Laurie, and first of all I want to thank Vic Noble for inviting me to be a contributor to his module on scalping in the Forex market, and I also want to thank Vic for his preceding contributions to this module. And furthermore, I want to congratulate you on your decision to engage in the foreign exchange market. I think that you are going to be fascinated by this market, and this market certainly does offer a tremendous amount of opportunity, and whatever it is that your objectives are, probably making money. I am assuming that the majority of the people that are watching this module are novice to intermediate traders, and I do congratulate you on what is going to be a everlasting learning experience, an ongoing learning experience in understanding not only the foreign exchange market, but I think financial markets as a whole. I am a commodity trading advisor, a registered commodity trading advisor, member of the National Futures Association, and I also manage private funds which are traded in the foreign exchange market. That is my primary business, but it's also been a pleasure now to, of course, be able to offer education to those like yourself and be able to share my knowledge with novice, intermediate, as well as advanced traders. I also do private consulting with advanced traders and fund managers. But of course, this educational module is going to focus on scalping in the foreign exchange market, and I will say up front that scalping is not, of course, my primary approach to trading in this market. I trade typically taking a more passive, what you could say passive or discretionary or moderate approach to the market. However, we are going to define scalping throughout the course of this module, and just to help you sort of to redefine. The reason why we've decided to put together this module is because there's such high demand for individuals who want to scalp in the foreign exchange market. And again, scalping is a matter of interpretation, which we'll talk about in a second. But people want action, and trading is not necessarily a high action, high intensity type activity that is portrayed. That image has been portrayed through television programs and so forth, and it's not necessarily like that. It's a little bit more passive in activity, but scalping certainly can be highly intensive and highly active, and I do scalp in the market from time to time, and what I'm going to share with you is my approach to scalping in the foreign exchange market. Now, for every individual, there is a different way of trading. Every participant in the market has their own unique application and way of approaching and trading in the market, whatever market that it is, and they will use different methods, strategies, different techniques. They'll all have different outlooks. For example, I could have a panel of 20 PhD economists, and we could ask them a question on where we think the euro-dollar cross is going, or the pound-dollar cross is going, or what's happening to the U.S. economy or the economy in the Eurozone, and they will all have divergent opinions. Okay, so what you bring to this market is an individual mindset that is uniquely your own, and the time at which you will achieve the most success in trading in any financial market is when you become an independent thinker. The idea is to obtain a vast knowledge of the market itself and become an independent thinker. And so for every trader, there is a different view and application to trading in the market. Now, concerning scalping, scalping really has many meanings. If you were to ask me, tell me how to scalp the market, or if you just say to me, I'm scalping the market, or refer to scalping the market in some manner, scalping has many meanings, and scalping can be simply a matter of taking advantage of price discrepancies between one price feed and another price feed through one broker versus another broker. Scalping can be simply taking advantage of small bounces that will occur in the market, or small moves that occur in the market which move on an intraday basis. And that is an area that we're going to focus on. Scalping may refer to simply an arbitrage that is taking place in the market. So, for example, A brokerage firm in the UK may have different prices than a brokerage firm in Asia or North America, and there can be some arbitrage and there are different sophisticated strategies with which you can take advantage of these price discrepancies. But again, it is highly sophisticated, and typically the retail trader does not have the facilities to do that, and even those who are skilled in that area have a difficult time with it as well. Then there, of course, there's what could be considered scalping at the bank level, where they are taking advantage of clients when working with dealing spreads on a consumer level, where they may have one consumer requesting to sell a certain amount of one currency, and then on the other hand they may have a buyer for that currency, and they simply take advantage or scalp on the spread in making the transaction between the buyer and the seller. So those are just a couple of different ways that scalping can be interpreted. Scalping is a higher risk activity when trading in the foreign exchange market, so the risk-reward ratio is forcibly higher, and so that, of course, must be understood, and we will, of course, shed some light on that throughout the course of this module. Just to give you an outline of what we're going to be covering here, we are going to first of all review some of the tools that I use in trading the foreign exchange market, and where we can anticipate that reaction levels will exist in the market. As well, we are going to look at specific key levels, or what we're also going to call reaction levels, and we are primarily going to focus on Fibonacci levels, pivot levels. Support resistance levels are probably going to be the most important, trend lines, and then there are other tools that you may use. For example, there are some indicators that we're going to use to help us to discern when there is a trading possibility, and so forth. We are going to look at the various time frames, understand the importance of specific levels on various time frames, and other considerations that have to be made is that, just as a brief definition, scalping is an attempt to take advantage of small price movement when price moves off major and minor levels of visible and invisible levels of support and resistance. Okay? Invisible meaning, for example, support and resistance are visible levels because those are levels at which the market has previously traded. Fibonacci levels, pivot levels, and so forth are invisible levels which we establish and determine to be a level of support or resistance that we will consider when making our trades. Some of the tools or reaction levels that we will be looking at, of course, are pivots, support and resistance, Fibonacci retracement and extension levels, trend lines, and then, of course, the use of personally preferred indicators and distinguished market characteristics that exist. So, for example, the time of day that the market is moving, what economic reports may be coming out, and other idiosyncratic factors that can play a part in the market we will also be covering as well.